Hi everyone, good morning. So today we will be starting with accounting questions and answers. My name is Deepak Bisht and I will be presenting to you the advanced questions which are used and asked during the interviews for investment banking, equity research and other research profiles in finances, and also for those who actually have an interest in finance. So for financial literacy also, you can watch these videos and this will give you a great benefit. So without wasting any time further, let's get started. So the first question here is asking us about the gap accounting difference between okay, how the gap accounting is different from tax accounting. So if you have watched our previous videos, so you know that gap accounting is actually accrual accounting. And when we looked into the Infosys Intel Corporation's finances. So we saw that the gap accounting is actually based on accrual accounting, which is preferred by which the companies actually follow the accrual based accounting, and the larger corporations follow the accrual based accounting, and the smaller corporations, the cash based accounting is called the tax accounting. So the differences are in the basics section of the readings, previously made videos. So gap is actually accrual based. Majorly, the preference is accrual based, and the tax based accounting is actually cash based accounting. The second difference here is that the gap uses straight line method, and whereas the tax accounting actually uses accelerated depreciation method, and this is a major difference in between these, because as per the government rules, the straight line depreciation is preferred, but the companies which use tax accounting, they prefer accelerated depreciation, where the asset is depreciated at a faster rate. And when you are depreciating at a faster rate, uh, there is a certainty to build a asset or a liability, deferred tax asset and a liability. And because to take the advantages in the taxation, the corporations do that, the smaller corporations do that. And as per the government rule, if you are running a business, there is a certain time period where you get a flexibility of not paying the business. But later on, when your business is up and running, you actually have to pay taxes to the government, even if it's small corporations or large corporations, if there is an income inflow. So you actually have to pay taxes. So in the initial ages, when the business are not certain, they use the accelerated depreciation and they take a tax advantage. So if so the major difference between the tax asset and liability is that even if you have paid more to the government, so government never pays you back in money. So government pays you back in benefits, or you can claim back the money in some different way, but not in the actual numbers. So the government will not actually pay you back the currency numbers, but in the hard cash, but they will give you benefit for the next and the further years. So you can if you look at the accounting, all the accounting statements of the organizations, you actually have to understand the history of the company first also. So that's why the data is very important part when we are looking into the financial of a company. And that's why I actually have shown you the SEC website, and that's why where the companies actually release all their financials. And I think to link up things, and without linking things, it's very difficult for you to grab the conceptual clarity. So okay, so let's move to the third point. So gap is more complex and more accurately tracks asset and liabilities, whereas tax accounting is only concerned with revenue and expenses in the current period and what income taxes you owe. So we have discussed this for later previously also, that bigger corporations do the gap accounting, the accrual based accounting, and the cash accounting is done by uh, the smaller corporations, where they are only their main concern is how much income tax they owe and how can they save the income taxes. Uh, Uh, just wait for the further videos also. I think in the later readings we have better content to understand these things. So these are basic questions only, basic and advanced questions only. These are the advanced questions, but they actually make you think about how the things are. So that's why even though it's just there are no numbers, but it's only definitions. But even though it's a tricky questions. So if somebody is asking you about these things, uh, they will actually try to test your knowledge. They will try to test your understanding of the concepts. So this is it. Question number one. We are done with question number one. Let's move to question number two. Okay, so deferred tax assets and deferred tax liabilities and how they arise. So let me just give you a context first. The context about it. So deferred tax asset and liabilities actually develop because of the difference in what the company does with their financial statements and what the government actually has the rules and regulations of the government. So if the government is asking you to do a double declining and you are in inside your organization, you are preparing your financials using straight line depreciation, so there is going to be a difference. So deferred tax asset, an asset is developed if it's a benefit, and a liability is developed. A liability is developed if in future you actually have to pay it. So asset is developed. So understand this thing. If today you are paying $100 to the government and $100 to the government, however, if as per the government your tax liability was only $80, so you have overpaid $20 to the government. So this will create a asset because you have extra paid. Today you are taking the hit, but today you have paid extra, and that extra amount will be uh, recorded on your balance sheet as an deferred tax asset. However, if the government actually had asked you about the government, as per the government policies, you actually had to pay $100, but you are paying only $80 today because of your internal uh, your internal accounting. So you actually have developed a deferred tax liability because you actually had to pay 100, but you have paid only 80. So this is how the liability is created. But in practice, we cannot say no to the government. We actually have to pay whatever the government is asking. But uh, we record those numbers. So the basic is you have paid extra here, you have paid lesser here. So this will create a liability and this will create an asset. But in if the government is asking about the money, so you actually have to pay the money. So that's a different thing, and we will discuss about it. Let's go. Let's not get confused. The basic definition of asset and liability for the deferred tax asset portion are these. But in the accounting financials, the treatment is different. So unless until I show you, you will not be able to grasp it. So let's read that explanation. They arise because of temporary difference between what the company can deduct for cash tax purposes versus what they can deduct for book tax purposes. So book tax purpose is a different thing, and the tax purpose is the different thing. Cash tax purpose is the internal accounting of the company, and book tax purpose is actually these terms are used for the government. Book tax, cash tax. So these are internal, and these are the government. I mean, when you are reading about these things, so if somebody is referring to book tax purposes, this means they are talking about the government part. So the rate which the government actually prefers, the rate at which the internal organization is doing it. Okay. So deferred tax liabilities arise when you have a tax expense on the income statement, but you have not actually paid that tax in cold hard cash yet. And deferred tax asset arise when you pay taxes in cash, but you have not expensed them in on the income statement yet. They are most common with asset write-ups, write-downs in M&A, merger and acquisition deals. An asset write-up will produce a deferred tax liability, while a asset write-down will produce a deferred tax asset. And this will arise a question: what is an asset write-up, and what is an asset write-down? So asset write up means the value of the asset. I assess that I have a factory, and the factory is worth, if I'm acquiring a company, they have on the balance sheet, they have recorded the factory is worth, for simpler numbers, let's take that $1,000. But I have assessed, and I am now I am referring I am now I am saying that the asset need to be write up. So I will increase the value of the asset up. So I'm saying that the asset is not worth $1,000, it's worth $1,500. So that will be a write up, and it will create a deferred tax liability. Why? Think about it. So if I am saying the asset is worth more, so it will create a deferred tax liability, because now earlier I have depreciated it, and when I am depreciating the asset, the value of the asset is declining. The value of the asset is declining. The value of the asset is declining. But if I'm saying the asset's value is more, so it will create a deferred tax liability, because now as per my financials, I actually have to I will be owing to government, because previously the calculations were wrong, and I actually have to pay more tax. So this is the basic fundamental here, which you need to understand. I know it's without any Excel or without any numbers, it's difficult to understand, but just understand the theoretical concept first. We will do everything, and I will make sure that all of you guys, all these concepts are crystal clear to you guys. So just understand this thing, how an asset write-up works, and how asset write down will work, and it will produce a deferred tax asset. So if I'm saying that I have paid extra $20 to the government, and I have paid extra, if I paid, okay, if I paid extra $20 to the government, so how will the government give me back that benefit? So if in earlier if in the next years, if I'm making a loss, like in COVID pandemic, if a company previously had paid a good amount of tax, or there is a deferred tax liability, and after and the COVID pandemic hit us, the deferred tax asset, I mean, there is going to be business. I mean, the business will be impacted, and the business will be impacted, and maybe next year there was no taxable income. So in that case, what the corporations can do is, they can use this deferred tax asset. Uh, they can use this deferred tax asset, yes. So they can use this deferred tax asset, and they can remove this deferred tax asset from their balance sheet. And also the government also analyzes your balance sheets. And that's why it's important that a accountant also verifies your financials. So audit is important. That's why. It's a very big arena where in which we can discuss these things. Deferred tax asset and a deferred tax liability is a the taxation part is actually a very big and vast universe in accounting, in finance. So, and everyone tries to save their taxes by and also government also gives you a benefit in tax saving. So. Uh, as of now, that's pretty much the information which will help you to understand the deficits and deficit liability. So, if we will discuss this in depth in later readings, uh, we will have this one session where we will discuss the I mean, that's why in the beginning readings, it was very important to understand the listings, the line items, because every line item has a very deep meaning and a very deep story with about them, and there are different treatments for all of these line items. Okay, so if you are new to the channel, I will rather suggest you to watch all the videos from the uh, all the videos. I mean, from zero to one, all the videos, introductory videos also. So that will make much more better sense, and you will be able to understand the whole story. Right. So let's move to question number three. Okay. So if somebody wants you to develop a revenue model, and I'm not sure how much you are familiar with the uh, forecasting and valuation part. So if you have not done any financial modeling or forecasting or valuation in your career as of now, don't worry about it. Theoretically, you should know these things. So theoretically, if you have to walk someone through your revenue model for a company, so there are two approaches. First, you look at the industry. So industry, as in, if I take the IT industry, IT as an industry, information technology, or I take communication services as an industry, so, which is a part of telecom media and technology sector. So So if I'm looking at the whole industry, I'm looking into cell phones. So uh, like uh, if for assume let's assume that for a country there are 20 million people in a country, and I am assuming that 20 out of 20 million people, only 70% million 70 million sorry 70% people out of 70 million is 14 million people are using a telephone, are using a cell phone. So I'm doing a top down. So I'm looking from the top, and I'm seeing, I will be looking at the bigger picture first. So there are 14 million people, out of which there are I will then look into the competition and how many companies are providing those services. Then I will look at uh, what our company has, what the company of our interest is doing, and I will come down. So I will start with the big picture, and then I will go down and see how much revenue can we generate. That's top down. So I will start with the big picture metric and overall market size, then estimate the company's market share and how that will change in the coming years, and multiply to get to their revenue. So this is an important part. Why? So even though we this is difficult, but this we use most of the times when we are comparing companies. So understanding the business model and comparing which company with which company is very important. So if you are comparing a company like Apple with Intel, that will not make any sense. But if you are comparing Apple with Samsung, and Samsung is actually into more vast number of products than Apple. So if Apple is only creating phones, iPhone, iPad, and other things. And Apple is also creating, and Samsung is, sorry, Apple is creating all these things, and Samsung is also creating televisions and laptops. And along with that, Samsung also have a wide range of products. But you cannot do that. So you will be only using the Apple iPhone. So if you want to see who is doing better in iPhone in the phone industry, so you will only look at the iPhone. The iPhone numbers you will compare with Samsung iPhone numbers only, Samsung phone numbers, and mm, Apple and Samsung and what and Xiaomi. If you look at Xiaomi, Xiaomi is also is now into make manufacturing of cars. Xiaomi has a wide range of products. So you will not compare Apple whole revenue with Xiaomi, because this will be a very bad mistake to do. That will not be practical. So you need to compare only phone, and that's why you actually need to understand how the financials are and how much is the impact of phones throughout the organizations. If you're comparing, and you are not, if you're then if you're not doing an apple to apples comparison, then you are doing it wrong. So you cannot compare an apple with an orange, or you cannot compare an apple with the other fruits. So it should be an apple to apple comparison, and for that you actually have to adjust your financials. So this is the top down approach, and for bottoms up approach, it's from down to up. We start with individual product and customers, estimate the average sale or customer value, and then the growth rate in sales and sales versus sale values to tie everything together. So this one is easier and this is more preferred by analysts. But the top-down approach actually makes you think in depth. And for that, you actually need to understand the industry, the sector, and everything. So the learning doesn't go waste. Learning never goes waste. So if you are learning about something, it will never go waste. It will help you somewhere. It will definitely help you somewhere. And learning never does go waste. So of these two methods, bottom up is more common. This one is more common, and it is taken more seriously because estimating picture numbers are almost impossible. And big picture numbers, metric over market size. Market size is the market cap of all the companies which are in the same sector. And like I told you from the example of population, think about think about these things. Like with, I mean, I have given you a direction. You can think anything, but uh, direction is important. So I think I have done the part, the major part here. So all the very best when you're looking at a top-down approach. But I will suggest you to learn these things also, even though they are not used. But it is important. So reading newspapers and reading magazines, industry news, sector news, uh, what watching news over financial channels. So this will give you a big picture, but when you are doing a bottoms up approach, you will be more focused on a single company or a single product or single type of customers. So let's move to the next question now. Question number four. Walk me through how you create an expense model for the company. It's pretty much same like the revenue model. So the revenue focus forecasting is the major I mean the major component of our income statement, and the expense model are actually created as per a percentage of revenue majorly. So the explanation says to do a true bottom up build, you start with each different department of a company, the number of employees in each, the average salary, bonuses, and benefits, and then make assumption on those going forward. Usually, you assume that the number of employees is tied to the revenue, and then you assume growth rate for salary, bonus, benefits, and other metric. So this is an important metric when you are analyzing a company's financial statement, but not from an investor's perspective, but from a management's perspective. And also from an investor's perspective, because understand this thing, this is revenue generated per employee, and this revenue generated per employee will be a indicator about how the management of the company how good the management of the company is. If good management is there, so the revenue generated per employee will be high. But if the management of the company is not, I mean, not liked by the employees, toxic, I can say, then people will have a tendency to switch their jobs. And training a new employee, and there will be high attrition and number of, I mean, you cannot expect a new employee to know everything about a company, even though the financial in the world of finance, the core concepts apply everywhere, but every company does a different every company has a different way of doing things. So attrition is actually considered a KPI, the KPI, key performance indicator. Yes, we can say key performance indicator for management, because it shows how good of a management you are. So, are you able to satisfy your employees' needs? Do you have the best talent, or are you able to retain your best talent? And why, if um, if not, why people are leaving the organization? So every organization actually has a budget for salary, bonuses, and other benefits and metric. If our older employees are leaving, so maybe they are not satisfied with their salary, bonuses, benefits, and other metrics. And if you are bringing in a new employee, so he will be asking more than what the company has the budget, and this will actually increase the expenses. And that's why more majorly they are actually moving towards artificial intelligence and technology. But understand one thing, that creating an artificial intelligence or AI model or uh, robot will be way too much expensive than create than people working in the live than actual people's working on your work. So uh, that's a different discussion. So let's not digress from the topic. So cost of goods sold should be tied directly to the revenue, and each unit produced should incur as expense. So they are actually tied to the revenue. So I'm assuming that every year the company is having 40% of the revenue as an expense. So they are out of 100, the 40 was the cost of making 100. To earn 100 rupees, you actually have to you actually have to spend 40 rupees, $40 so that's why the revenue is tied to cost of goods sold. So how much percentage of revenue was the cost of goods sold is an important metric. So other items such as rent, capital expenditure, and miscellaneous expenses are either linked to the company's internal plans for building expansion plans if they have them, or the revenue for a more simpler model. So simpler model, yes, in simple terms, you will link everything to the revenue of the company. So capital expenditure, linking to the capital expenditure indicates that you are investing in the capital assets of the company. So capital expenditure is that you are out of this revenue, you are creating this much amount every year as a asset. So you are developing an asset. An asset will, even though asset is an expense as of now, but as the basic definition of in an as of an asset is that in future it will help you making more revenue, and that's why it's called expansion plan. That's why they have written it as expansion plan. And rent, if you are investing more into capital expenditure, you I mean plant, property, and equipment. So this means in future you will be having this rent component will be lesser, and you will have a more assets. So you will have this, but companies use rent as why companies, if a company can afford to have a uh, building of their own, so why do they prefer to rent? Because if you are having this much capital if you are initially you are having a lot of assets, and you are not able to generate the income from, I mean the return on income actually component, if it's a ratio, that ratio will be very low. So nobody cares about uh, what your company doing, but I mean your future plans and all, but they'll look into the numbers, and only the organization can do it in a detail. So if I am very much interested in your company, then only I will look into that. If I'm an investor, or then only I will look into that. But see, capital expenditure doing it slowly, and only when the company is working good, everything is good, going good with the company, then only it makes sense. or else it will mess up your return on investment numbers or return on asset numbers. And there is always an opportunity cost with the money. So if you have $1 million and you put it all into a asset and you are not even generating, for example, 2% of 4 million, oh sorry, 1 million, 1 million you have spent on capital on PPE, and you are not even generating the US risk-free rate, then it would be much more better for you to put that money in US, I mean, in a bank account or a government securities. So if you can only earn more than that, that's the opportunity cost concept. So you actually have to use your money very wisely. So don't just spend on, don't be an impulsive buyer. So you actually have to spend your money very wisely. So, and you, if you are interested in finance, then not only just think about these things, not from the perspective of a company, but from your perspective. You actually have to change your thought process first. So, okay, so let's move to question number 5 now. So let's say we are trying to create these models, but we do not have enough information on the company, and company doesn't tell us enough in its filing. So what should we do? So we use estimates for revenue. If you do not have enough information to look at separate product lines or divisions of the company, you can just assume the simple growth rate into future years. Okay. So if the company is not providing you those numbers, and maybe this is happening because it's a new company, it's a company which is not listed on the stock exchange. They do not have any obligation to uh, publish their financials. You can go to Twitter, which is now X. They do not publish their financials anymore because they have delisted themselves. But earlier, when Twitter used to publish their financials, uh, the data was different. So unless until I have 2 3 years of data, I will not be able to make a trend. But if today if X listed itself back and they have started to provide me numbers, I will not be able to make a assumption unless until I have a history or a at least 2 to 5 years of data, only 3 to 5 years of data. Then only I will be able to make a track, an estimate on the numbers, the how the company is going and how it's going, how the organization is. I mean the revenues and the forecast, everything. So what they have done new. So maybe this is one case, and I'm not able to think of any different case now. Uh, this was a case of X, and let's not think about it more. If the example will come to me, and then I will explain it in my next video. So, the company doesn't have enough in its filings. Okay. So don't have enough information. Okay. So, but if once you have forecasted the revenue, then you can forecast the expenses on the basis of revenue as a percentage of revenue. If you don't have employee level information, then you can assume that the major expenses like SG&A as a percentage of revenue and carry the assumption forward. Yes, we have previously discussed this thing. So if you are not able to, so understand this thing that the revenue is the major component. And when we have seen the income statement part, unless until we have the revenue, we will not be able to make the other, we will not be able to calculate the other parts of the income statement. So revenue forecasting is the major, and you need to be you need to where you need to be calculative, and you should analyze first and then forecast your revenue. All those equity research analysts and then investment banking analysts who are tracking or forecasting the companies or publish articles about forecasting the numbers and the valuation of the company. They have been tracking those companies for the past 10 to 15 years, and that's only their job. So they know about the company, the business model, and everything just like the back of their hand. So on their fingertips. So this is this much intense and detail oriented, and if you are if you want to make a mark in the finance world, you should be that much detailed oriented and that much uh, intensely in love with finance. So that's been said. Let's move to the next question. Walk me through the major line items of your equity, and we have done that previously also. So the major line items are common stocks. So par value of how much however much the stock of the company has issued, retained earnings, how much the company's net income it has saved up over time. So yes, retained earnings is net income. We subtract the dividend, and then the rest of the portion we uh, it goes to the retained earnings accumulated deficit, part of the shareholders equity, additional paid in capital, APIC, also for the shortly called APIC. This keeps track of how much stock-based compensation has been issued and how much new stock employees exercise options have created. It also includes how much over par value a company raises in an IPO or other equity offerings. So, as by the definition, and I think it's pretty much clear. So let's move to the next. Treasury stock, the dollar amount of shares that the company has bought back. So every if you have ever seen of company's financial statement, so every quarter, every now and then, a company actually buy back their uh, stocks from the company. So what does that uh, does is so they will actually have to pay lesser dividend in future, and the equity in terms of the definition, by definition, equity means ownership. So more the owners, the more conflict, and lesser the owners, the lesser conflict, and it is better to manage if there are not too much people. If I hope you understand what I'm trying to say. The lesser the people, it's better. So authority remains with the only few people. So this is a very important thing to look at treasury, not with but not from the perspective of equity, but also from the perspective of a company and investor. And if there are lesser stocks, so lesser shares in the market, then the return on equity also increases. Accumulated and other comprehensive income. So this is a catch all. So other, I mean, anything else, it goes to other comprehensive income, accumulated and other comprehensive income. Okay, so let's move to the question number 7. So, okay, retained earnings portion, we have discussed that all retained earning plus net income minus dividend. Okay, to walk me through what flows into retained earnings. Retained earnings is old retained earnings, the previous retained earnings on the balance sheet. We will add the net income and we will subtract the dividend issues. And dividend issues part will be the how much dividends been issued, the how much amount has been spent on the dividend issue. It will be reflected in cash flow from cash flow statement. If your calculator retained earnings from the current year, take the last year's retained earning numbers, add this number net income, subtract how much ever your company paid out in dividends. So that's pretty much easy. So next question. Okay, APIC. I mean APIC considers the impact of stock-based compensation and value of stock created by option exercises. So APIC is additional paid in capital. The old APIC, we will add back the stock-based compensation, and The value of stock created by option exercising. Okay, so what is the stock-based compensation and what is stock created by an option exercise? So companies give their employees ESOPs, employee stock ex- employee stock option plans, or to certain investors also. So so they will give them an option, call option, to buy stocks at a specific rate. Like for instance, my company's stock is worth $50, and on the option I have given to the investor that they can exercise the option only at $60. So there is a concept of in the money and out of the money. So $60. So if somebody can $50, $60. So understand this thing. If the product is $50, you will not pay $60 for that. If in the market the product is $50 and I am saying that you can buy it at $60, you will not buy it because you can buy it from the market only. But if the product is $100 and I am giving you an option to buy it for 60, that will make more sense. So you can buy that stock at $60. However, if you go to the market, you will get that same product at $100. So in that way, you will get a benefit of $40. So this is an option which is in the money. So in the money means there is a benefit, and out of the money means there is no sense of making that purchase because that will be a loss for us. So in the money, out of the money. So exercise options when if there is a startup and the company is raising money from the investors, so there is a the startups actually do give options to the investors also because uh, there is a risk involved in those companies. So debt, along with debt, if they are raising debt, so debt also, if I'm raising debt only, so bank will only get 10%. I am assuming 10% return. But if I am raising debt and the investor is giving me raising two types of debt. Raising equity and I am raising debt. So there are options where uh, there are embedded options where the debt holder, the company, the investor who has invested, they actually have an option to increase their spread if the companies do good. And in the initial stage, it's very difficult unless without a track record. And most of the startups actually fail. So this is important to understand from the perspective of value stock created by option exercises, what the option exercises are. And stock-based compensation, more the stocks, there will be more compensation on the stock base. So these things. This is also a very vast topic of discussion. So as of now, it's for understanding purpose, uh, it's enough for a person who is actually looking into Q&As, interview for interview perspective. It's not it's enough, I think. So let's move to next question. The statement of shareholders equity and why do we use it? So statement of shareholders equity, it's the fourth statement after income statement, cash flow, and balance sheet. The fourth statement. So whatever the changes are in the shareholders equity, it will be recorded in statement of shareholders equity, also called SOCE, SOSE, SOCE. The statement shows everything we went through above, the major items that comprise shareholders' equity, and how to arrive at each of them using the numbers elsewhere in the statement. You do not use it too much because it can be helpful for analyzing companies with unusual stock-based compensation and stock option situation. So we do not use it much. But if we actually have to look into stockholders' equity portion, then only we use it. And it is very helpful when analyzing company with unusual stock-based compensation. So if there are unusual stock-based compensation, then there is way too much risk involved with the company also. So if it's a very risky company, then you will look at the statement of shareholders' equity. You will also look at the shareholders' equity. Okay. So 10th question is, what are the examples? So this is basically uh, easy, or there is nothing, there is no practical approach to it, but you can remember these things. What are the examples of non-recurring charges, and we need to add back to the company's EBIT, EBITDA when looking at these financial statements. So yes, so the non-recurring charges are restructuring charges. Every quarter, the company doesn't restructure. Goodwill impairment, you cannot impair goodwill every quarter. Asset write-downs, bad debt expenses, legal expenses. If the company is way too much in litigations and all, if a lot of people are suing, or there are legal notifications to the company, then it's a bad company to invest in. Disaster expenses, disaster is a one-time expense. The non-recurring means they do not reoccur, or they are only one time. The change in accounting procedure, you cannot change accounting procedure every now and then. This is important. Accounting procedure should be done retrospectively also. If you are today changing any accounting procedure, then you actually have to change all your financials retrospectively only. This retrospectively also. So yeah, that's pretty much it. So this was the 10 questions out of 15, and the next 15 questions we will discuss in next reading. Kindly subscribe to my channel if you have learned anything of value today. And thank you. Thank you for watching. I will see you soon in the next lecture.